Hello, everybody. This is Tim Froberg from Finest Retirement Services. Welcome to our four-part lesson on how the stock market works in the context of your retirement account over time. Whether you have an IRA, a 457, a 401k, a SEP IRA, a 403b, whatever you got. Okay, we're here today to talk about, and I'm just going to run through, we're going to break this lesson up into different videos so we don't put you to sleep. But we are going to run through how the stock market really operates over long periods of time and how to best create massive wealth for yourself and your family in these accounts. Okay, so let's get into it. The first thing I would like to discuss is really market volatility, and over time, as we're watching the market go up during good times and at the time of this video, down during bad times, understanding how to contextualize that, how to think about it, and how to act on it as we're dealing with that short-term volatility and what's happening over the long term. Okay, so let's get into this. Over the short term, the market is like a yo-yo, right? And that it goes up and down. Not a difficult concept. Sometimes it shoots up, sometimes it comes down. But over the long term, period of 20 years or more, and guys, this is what has happened historically. Let's keep that in mind. Past performance does not ever guarantee future results. But when I say historically, I'm going back 3 digits, right? I'm going back 100 years, 40 years, 20 years, right? When we're looking at these long periods of time, here's what happens when you invest in high quality, diversified baskets of stock or equity. I cannot emphasize high quality and diversified enough in that statement. Really important, okay? Over the long term, what happens is your yo-yo goes up and down, but your yo-yo functions as if you are walking up a hill or walking up a cliff, mountainside rather, okay? So here we go. We go 20 years. And by the time you hit 20 years, you've seen a lot of ups and downs, okay? But at the top of that hill, even if you drop your yo-yo and you get a run down after it, guess what? You're a lot higher than you were a long time ago. And that's because high quality indexes and other baskets of high quality companies, right, both big, medium, small, and of international asset allocation over time tend to grow with the global economy. All right. So what's the point? What's the lesson? What can we get from this? The point is not to overthink and always speak with your personal investment advisor, speak with your fiduciary. Really, really important. Everything should be tailored to your situation. Okay. This video is not advice for you. It's education. Advice for you requires knowledge of your situation. But to finish my statement, do not overthink the violent ups and downs of the market in the short term. And please do not try to be smarter than the global collective of market traders and market investors. It doesn't always work out. The last thing you want to do is accidentally sell at the bottom. When we all know what we should be doing over the long term at the bottom, we should be buying, dollar cost averaging, continuing to make our contributions, maybe even up them during periods of immense market volatility. Over the long term, great thing to do, okay? So this is a helpful chart, but it's not exactly the most accurate depiction of how the market actually grows over time. This is an illustration, and you have to understand this illustration so you can really get what's actually going on and why we actually get wealthy when we kind of follow the rules, right? When we do this right. So how does the market really grow over the long term? Well, it grows on something called a compounded curve, okay? What does that mean? It just means this. Let's say I have $10,000 invested on year one. And let's say in this example, it's pretty close to the actual average. The market makes, I'll use a round number, 10% a year. We're going to keep this simple. We're going to stick to that average number, okay? The actual chart might look a little different, but same concept, same effect, okay? We're going to stick to that 10% number. So I have $10,000 invested that makes 10% on year one. Well, how much money did I make? I have 10 grand and it makes 10%. I made $1,000. And the next year I have, without any contributions, keeping it simple, $11,000. Now this is crucial. When I make my 10%, in this very simple example, the next year, did I make $1,000 again or did I make more? I made more, right? I made $1,100. Now that bigger number gets reinvested, creating another bigger number, and all of a sudden, the interest we are making, whether by dividend or just capital appreciation, right? The interest that we are making is compounding. And the goal of long-term aggressive asset management is to hit the bend of this compounded curve. The bend is very, very powerful because what's happening at the bend? Why does it just take off all of a sudden? Well, because one day when you've got $500,000 in this portfolio and you make 10%, you've made a small salary, right? And if you have a 20% or a 30% year, you'll really start to see the curve kind of take off, okay? So sometimes the goal is to just be patient through the ups and downs, dollar cost average, and attempt to reach the bend of this compounded curve. Depending on your financial situation, speak with your personal advisor. I can't say that enough, guys. Every financial situation is different. These are investment principles and historical facts from just history, okay, that might help guide you on your path as you're speaking to your fiduciary, all right? Now, I'd like to get into your retirement accounts, okay? How does this concept kind of fall into your 401ks, your deferred comp, 457, your 403bs, your SEP IRAs, whatever you got, okay? How does this concept actually fit into that? What's happening, okay? And what are some mistakes that we see at the practice all the time? All the time. Mistakes that we see that actually can mess up the growth attached to this compounded curve. Okay, let's talk about these mistakes, okay? Because this is like super important. The number one mistake that we see is that our clients are not in what's called a customizable or customized asset allocation. They haven't sat down with their advisor in their 457 or 401k and decided how much large cap should I own? How many small companies should I own or how much, right? How much international exposure should I have? Do bonds or cash or alternatives have a place, if available, in this portfolio through my workplace retirement plan? These are big questions. All too often what we see, and it's not a bad thing, okay? It's the lesser of two evils, but what we will see is somebody pick a target date fund. What's a target date fund? I don't know, pick a year, 2040, and we'll just say fund. Okay, it's making this up. So let's say you're in the 2040 fund, right? You're in a target date fund that is intended, what these are intended to do, and again, not a terrible thing, they are intended to pull risk off of your portfolio as you approach retirement. So you're telling the system, I'm approaching retirement at 2040, and a portfolio is constructed that is designed to remove risk from your portfolio until 2040, at which point you'll have a much less aggressive asset allocation. Now, the problems with this are twofold. Number one, depending on the target date fund, sometimes the safe assets, let's say bonds, right? Let's say bonds are dropped in way earlier than you need them to get dropped in. So your returns, if bonds are yielding less than stocks, which historically over the long term is the case, your returns start to get depreciated a little too early. So that's every 10 years, 5 years, whatever, they're dropping this in. What ends up happening is you have a bit of a smoother ride, a lot earlier than you needed to, and you're compromising your growth, specifically, the bend of that curve. Right when things are supposed to get really wealthy, you're throwing water on those returns, okay? So that is inherent problem number one with the target date fund. And the other inherent problem is timing, okay? This is big, all right? The timing thing is a problem Because your portfolio in your workplace retirement plan is going to drop these bonds and sell stock, typically, right? They're going to get rid of that arbitrarily. What does that mean? Think about COVID, right? Think about when the market was down 30%. Stocks were down and bonds were at a premium because they were trading up. Yields are really low, right? So stocks are down. You're supposed to be buying stocks, and what are they doing? They're selling it arbitrarily because you hit a certain milestone, let's call it, okay? They're selling stocks low. They're buying bonds where? They're buying bonds well, they're expensive. It's kind of the opposite. We want to buy low and sell high. The arbitrary nature of the target date fund exposes us to this risk. It's not to say it happens all the time. Sometimes it works out, but it removes your control as an investor. It removes your own say and your own strategy as a part of your destiny, and it's deciding. Some program is deciding whether or not you're going to leave your job with 7 figures or 6 figures, whether or not you're going to leave your job and need another job, whether or not, if you're somebody who owns a pension, if you are going to have an effective pension supplement or not. Problematic. So speak with your personal advisor before making any investment decision. Super important. Speak with your personal fiduciary, somebody legally obligated to place you first. Talk about your plan and ask them, hey, what is your opinion? Do you think this target date fund is all right? Or do you think I should be building a more customized asset allocation and changing the portfolio based on my life and my expectations and my plan? Or should I be letting some system do it for me? And if you're reading between the lines, it might be obvious, but I think you understand where we sit on this at Finest Retirement Services. Target date funds can be an appropriate thing in some situations, and quite frankly, based on the target date fund, some of these things are actually really good, but more times than not, it is helpful for a client to examine their own financial picture with that advisor and build a portfolio that speaks to and works for them, their goals, okay? Super, super important. Now, what has to happen at a deeper level? And this is why there's a version of this video that's chopped up into 4 pieces because it's too long. But what has to happen at a deeper level? All right? At a deeper level, within that portfolio that's built, there's a really important risk that you need to understand if you went and tried to do this by yourself, which is why we don't recommend it. Let's say you build an efficient, modern portfolio, okay? You opened a textbook and you found an efficient modern portfolio and you looked at your 457 or your 401k, your 403b, and you said, all right, I'm going to put, half of my money in the S&P 500. I'm going to put 15%, just making this up, in small companies. I'm going to do 15% in medium-sized companies and 20% in international. I just made this up off the top of my head. Do not do this based on this video, all right? It's just kind of pulling it out. Now, let's say this is your portfolio. Today, what might happen over time after you build it, and then life happens, and things are happening. You're not staring at your portfolio every day. If you are, you may want to change that habit. It can lead to like market timing and other problems. But let's say over time now, small caps do really good, right? So small caps grow a lot. I don't know, there's a huge push in the country economically. Things are going really well. Small caps are now a really big part of your portfolio. Not the plan. Not the plan. Cool, not the plan. And let's say, I don't know, Amazon and Google get regulated, right? The S&P gets slammed, the dollar's high. I don't know, right? Large caps go down. Well, this is called, and international goes down because they can't stop fighting over there. This is called portfolio drift, okay? This is called portfolio drift. Our original portfolio has drifted into something untenable. Okay, we wanted Captain America fit, ready to go, and we got the Hulk. It's big, but it's dangerous. Okay, anything can happen. What do I mean by that? What if you're in a situation where down the road, half of your portfolio is small cap or small companies, which are the most prone to bad economic events when they happen, right? Imagine the losses you're going to see after all that hard work saving. So how do we fix this, right? You need to speak with your fiduciary and make sure that your portfolio is doing something called rebalancing. Not the best handwriting. Hope your volume's on. Okay? Rebalancing. You need to make sure that if something got too big and something went up, like small cap in this example, something went up, you are trimming it off. You're selling it at a profit. And then you're taking that profit, selling high, right? And you're reinvesting into whatever did not do well. Let's say that quarter. Okay, professionally, we do this via percentage. We watch it every day. In your workplace retirement plan, your 401k, listen, they're not going to do that. Or if they do, I'm giving them big props. Typically, this is done quarterly, annually. You'll speak to us as to when it really should happen. Okay, that's kind of an important concept, a little out of the scope of this video, a little next level. But we'll get into it in the future. Okay, but selling high, just pivoting back, selling high while small cap is up and doing what, right? We're buying low while other things are down. This is doing two things, okay? And we did not make this up here at Finest Retirement Services. This is Harry Markowitz. This is Modern Portfolio Theory, 1950s. Awesome stuff. Really, really important. Rebalancing all that, okay? But you're doing two really, really important things. One, you're keeping the portfolio efficient. You're keeping the allocation that you originally thought made sense for your risk tolerance, goals, and time horizon. And you're constantly selling high and buying low automatically. Now, if the market's going down, the market's taking a dip and things are really bad, you're just going to typically stack onto your contributions, add more while it's down, and beef up that compounded curve. And these are all of the elements, all right, bringing us right around to this 17-minute lesson so far. These are all of the elements, or at least the important ones on the top of my head right now, that you have to understand when you're approaching your retirement account with your fiduciary. Changing a couple of little numbers in that account and making sure the rebalancing strategy is happening and making sure the asset allocation, which may look a lot different than this for you, fits your time horizon, risk tolerance, and goals, can have an enormous impact. Enormous on your net worth in the future. It can decide whether you're living on an island and taking passive income or whether you're leaving and working an additional job when you're done. Decisions like these are one of many, by the way, in financial planning, but those little decisions, those little adjustments in your portfolios, those little 15-minute in front of a computer, just adjusting things can have an enormous impact on your future. So I am urging you to sit down with your fiduciary today, your personal financial advisor, whoever that might be, that has to place you first, and open up those retirement accounts from the workplace and make sure that everything is lined up with the rest of your plan. I'm Tim Froberg from Finest Retirement Services. I hope you learned something. I hope the board was somewhat clear here. If not, give us a call and we'll be happy to get you in. Have a great one.